Hello, friends. Welcome back to Curious Commerce, Capital Budgeting Series 17. Till now, we learned how payback period works and how to calculate it. But now, an important question arises: is payback period a perfect method or not? Can managers depend only on payback period while making investment decisions? The answer is not completely. Every financial method has strengths and weaknesses. Even though payback period is very popular because of its simplicity, it also has some serious limitations. In today's session, we will carefully analyze both advantages of payback period and the limitations of payback period. By the end of this video, you will understand why companies still use payback, why managers cannot rely on it alone, and how professionals combine it with other methods like NPV and IRR. So let us begin today's session. Students, one important principle in finance is this: no method is perfect. Every capital budgeting technique has benefits, drawbacks. It is suitable situations. Payback period is popular because it is simple, fast, and easy to understand. But simplicity sometimes creates problems because real business decisions are complex. Suppose two projects recover investment quickly. Does that automatically mean both are profitable? Not always. A project may recover money fast but produce low total profit. Another project may recover slowly but generate huge long term return. So, managers must understand where payback helps and where it fails. That balanced understanding is the goal of the session. Now, let us first understand the advantage of payback period. There are three major benefits. First one is it is simple and easy to understand. Second one is quick decision making. The third one is the risk reduction. These are the reasons why many companies still use payback period even today, especially small businesses, startups, retail businesses, manufacturing units often use this method because sometimes managers need quick answers, easy calculations, fast screening of the project. Now, let us discuss each advantage in detail. The biggest strength of payback period is simplicity. Students can calculate payback period easily. No complicated formulas, no discounting tables, no advanced finance knowledge required. Even beginners can understand it quickly. For example, if investment is 1 lakh and annual cash inflow is 25,000 rupees, then payback period equals investment divided by annual cash inflow, that is 1 lakh divided by 20,000, 25,000 rupees, that is 4 years. It is very simple, right? Because of this simplicity, managers save time, employees understanding quickly, communication becomes very easier. This is especially useful in small companies where advanced financial experts may not be available. So, simplicity is one major reason for popularity of the payback period. Another advantage is quick decision making. In business, sometimes manager cannot spend weeks to analyze every project. They need fast decisions. Suppose a machine suddenly breaks down, a competitor launches the new technology, or the market demand changes rapidly. In such cases, companies need quick project evaluation. Payback period helps because of calculation is fast, data requirement is low, decision making becomes easier. Managers can quickly compare the multiple projects. For example, project A recovers in 2 years and project B recovers in 5 years. Immediately, managers know which project recovers money faster. This speed is very useful in dynamic industries. The third advantage is the risk reduction. Now, let us discuss another major factor. Students, longer projects are generally riskier. Why? What is the reason? Because future is uncertain. Things may change. Technology may change. Government policies may change. Market demand may change. Competition may be changed. Maybe the economic variable of inflation may be changed. So companies often prefer projects that recover investment quickly. Shorter payback period means faster recovery, less uncertainty, lower financial risk. Suppose two projects exist. Project A recovers in 2 years and Project B recovers in 7 years. Naturally, many managers feel safer with Project A. This is especially useful in unstable economies, fast changing industries, and high risk markets. Therefore, payback period is considered a useful risk analysis tool. Now, let us move towards the limitations of the payback period. Even though payback has advantages, it also has serious weakness. Main limitations are it ignores time value of money. It ignores future cash flows after payback. It does not focus on profitability. These limitations can lead to wrong investment decisions. That's why professional financial managers usually combine payback with other methods. Now, let us study each limitations carefully. One of the biggest problem in payback period is it ignores the time value of money. Students, remember this important concept. Rupees 100 today is not equal to the tomorrow's 100 rupee. Why? Because today's money can be invested, possible to earn the interest. It increase the value. Inflation also reduces the purchasing power over time. But traditionally, payback period treats all cash inflows equally. For example, 10,000 rupees received today and 10,000 rupees received after 5 years. According to the payback period, it treats both equal. But financially, they are not equal because of this limitation. Wrong projects may be selected. Accurate value measurement becomes difficult. This is why advanced method like NPV, discounted payback period, IRR, it means that internal rate of return, becomes the important. Another major limitation is payback period ignores cash flow after recovery period. This is very dangerous. Suppose project A recovers in 2 years, then earns nothing. Project B recovers in 3 years but earns huge profit after 10 more years. Traditionally, payback period may select project A because the recovery is faster. It means the payback period is less. But project B may actually be far more profitable. So, payback focuses only on how quickly investment returns. It ignores how much total profit earns through the project. Therefore, payback gives incomplete analysis. Managers must understand this carefully. This limitation is closely connected to profitability. Payback focuses mainly on recovery speed, but business's objective is not only the recovery, the real goal is profit maximization, wealth creation, and long term growth. Sometimes, highly profitable projects may have slightly longer payback period. If the manager focuses only on quick recovery, they may reject excellent investment opportunities. So, payback should not become the only the decision criteria. A smart manager balances the risk, liquidity, profitability, and long term value. This is extremely important in strategic financial management. So, what do professional managers actually do? They rarely use the payback period alone. Instead of that, they use it as a screening tool. It means first filter risky projects using payback period, then analyze shortlisted projects using advanced methods. Usually, managers combine payback period with net present value, internal rate of return, and profitability index. This creates balanced decision making because payback gives liquidity information, NPV gives value creation, internal rate of return gives profitability percentage. Together, they produce better financial decisions. Let us quickly summarize today's lesson. The major advantages of payback period is it's very simple, fast to calculate, useful for risk analysis. The limitations of payback period is ignores time value of money, ignores future cash flows, does not focus on profitability. The final conclusion is payback period is useful but not sufficient alone. It should be combined with other capital budgeting techniques for better investment decisions. This understanding is very important for exams, interviews, and practical business situation. In the next video, we will learn accounting rate of return, that is ARR. There we will understand ARR formula, average profit concept, investment comparisons, advantages and limitations of ARR. So continue learning with Curious Commerce. If this video helps you, like, share, subscribe, and continue our journey towards mastering finance and capital budgeting. If you need daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. Once again, thank you everyone.